How does your 401k affect your tax bill? I'm going to show you using this awesome online calculator. It's free to everyone. Don't use this to file your taxes, but it can give you perspective on how your 401k affects your income in the year that you use it. Let me give you a tip. Cash flow. Cash flow. Let's look into it. All right, so check this out. Let's create a scenario. Let's say it's 2022, you're married filing jointly. It seems like that's the most common. And let's say between the two of you, you make $200,000. Let's simple. Let's calculate it. Let's see what happens. So based on this, using some standardized numbers, your gross pay is 200,000 bucks. You didn't put anything in the 401k, no other tax deductions. The standard deduction that you're given is $25,900. That's your new taxable income, $174,100. Based off that number, your federal income tax, your Arizona state tax, your Social Security, your Medicare takes you to taking home 150 grand a year, which is 12,000 bucks a month. In this scenario, currently, you don't have any savings, you don't have anything going on. This is just your tax situation. Because if you were to take some of this $12,647 and just throw it in a traditional brokerage account, you don't get any sort of tax deduction at all. It doesn't help your tax situation. It's just you're taking some of your cash flow and investing it. If you put that money in a Roth IRA or a Roth 401k, there's no deduction on your taxes. Your tax bill is going to be the same. It just may affect your cash flow. So let's see what it would look like by using a 401k. They put it under the IRA. So let's say you did the max, 19,500. Actually, let's do this real quick. So this is our original amount. Let's stay here. We can use this as a baseline under our quick calculation. Okay, so 12,647 is our monthly. 151,000 is our take home, and we have a total tax paid of, for federal, state, Social Security, 29,000, 6,000, 2,000 respectively. Okay, so let's use this next tab. Let's do the same thing. $200,000, married filing jointly, IRA. The maximum you can put in for 2022 is 20,500. Sorry, I think I said 19,500 before. 20,500. Can't use an IRA because you make too much money. Sorry. Now let's calculate it. Ooh, so things changed a little bit, didn't they? So you put 20,500 into your 401k. That reduces down your taxable income to 153,600 compared to 174,100. See how that works? The taxable income is basically a dollar for dollar reduction of that 401k and the circumstantial exemptions, which is basically just the standard deduction. So your take home after the 401k is 135,000, monthly is $11,315. Comparatively 12,647. So your take home on a monthly basis goes down $1,300 by contributing to your 401k, getting that upfront tax deduction. That's how the 401k works when you're using the pre-tax component. This isn't the Roth or the after-tax bucket. But this could be really valuable in your retirement planning. I'm not saying you should do this. I'm not saying you shouldn't do this, but you need to understand what's most valuable to you. Paying some taxes now, or should you use the traditional 401k with the Roth component? Because if you use the Roth, this is the exact same calculation as before, but the cash flow changes. So your taxes stay the same as the original calculation that I showed you, where there was no 401k contribution. The tax calculation stays the same, just your cash flow is reduced because the money goes post-tax into the 401k. Let me know if you have any questions or you want some more information like this. Like and subscribe. We can even probably put this link in the comments below. Also, subscribe to the newsletter. It's going to be coming out in a few weeks for February. There's always good information. The Wealth Wad. Thanks for listening.